Aloha, everybody. Marc Geredes back again from Sunday with this week's installment of Market Minute. So last week we went a little bit long, sorry about that, about the past and present situation with housing inventory in the United States and provided some thoughts on why we think housing inventory should increase slightly in 2024. So this week we want to turn our attention to something called real hourly earnings and how that might be helping consumers maintain their lofty spending habits that we talked about a few weeks ago, despite their lower savings and increasing debt burdens. Let's go take a look. What exactly are real hourly earnings and why should I care? All right, so in simple terms, real hourly earnings are a person's wages after adjusting for inflation. So for example, if you're paid $20 an hour, your earnings are effectively higher than that in a period of low inflation where you can actually buy more things than in a period of high inflation where you can actually buy less things with those same wages. So hopefully that makes sense. The chart you see in front of you right now on your screen represents the year-over-year change in real hourly earnings in the US by month. So just as we've done over the past few weeks, we're going to break down what's happened with real hourly earnings into the three time periods: pre-pandemic, during the pandemic, and post-pandemic. All right, so pre-pandemic. Pre-pandemic in this case covers the period from 2014 to late 2019. And as you can see by the yellow or goldish arrow here, during this period, real wages were just kind of bumping around between 0 and 2.5%, basically keeping up with or slightly exceeding the rate of inflation. Then during the pandemic itself, this time covering the period of late 2019 through April of 2021, first what happened was real wages spiked up from late 2019 through April of 2020, which can be explained by the fact that people were locked down and not spending any money. So the cost of things fell considerably. Lots of supply of goods, but very little demand. So prices go down. But then interestingly, this dynamic flip-flop from April of 2020 through April of 2021, as you can see by the red arrow here, all of a sudden people started spending again when they got set free from COVID. But there were supply chain issues at the time, if you can remember. So the cost of things actually increased considerably, so much so that there was too much demand chasing too few goods. That caused prices to go up. All right, and the post-pandemic period, this time from April of 2021 to present, you can see, again, by this green arrow, it takes almost 2 full years for real wages to catch back up with inflation. You can see that real wages finally turned positive after April 2023, which also explains why people were saving less over this period of time. So putting it all together, what does that mean for consumer spending in 2024? Well, if you think about it, consumers are understandably feeling better than they felt over the past few years, but they're still not feeling great. It's taken 4 years since the start of the pandemic to get back to where real wages actually exceed inflation, basically a lost 4 years. What happens in 2024 depends on a lot of things, but most notably, will the Federal Reserve's efforts to bring down inflation by keeping interest rates high slow spending, resulting in an increased unemployment rate? So if they keep rates high for too long, is that going to slow spending so much that basically employers have to start getting rid of jobs? Only time will tell. Well, that's all I have for this week. Next week, we'll spend a minute or two discussing the recent settlement reached by the National Association of Realtors over real estate commissions. Until then, aloha, everybody.